Welcome to the Retail Focus Podcast, a weekly collection of news, interviews, and information from the world of retail. Here are your hosts, Trent Kling and Leighton Kling.
Welcome to the last edition of the Retail Focus Podcast for 2018. Trent Kling alongside Leighton Kling. Coming up today, we've got a couple of news stories, but the bigger part of this episode will be centered around our 5 least performing retailers of 2018 and our 5 highest performing retailers of 2018. It's something we do every single year. We come out with this list and we'll tell you who is on it again after last year and who might be a new entrant to the list. One thing is for sure, because we exclude bankrupt companies, Sears Holdings for the first time will not be the least successful retailer on the least successful list. Please subscribe and rate us however you listen. Also follow us on Twitter or Instagram at Retail Podcast. We see the number of followers steadily increasing on those platforms. Feel free to shoot us a DM as well if you've got a story idea. Now, one thing I want to note at the beginning of the podcast, I sound a little bit different because I'm feeling a little bit under the weather, so we're going to be relying on Leighton to maybe carry a lot of the load here in this podcast. But a quick story before we cut into our best of and worst of 2018, as Mastercard releases data that suggests bullish early forecasts on holiday spending in 2018 were more or less correct. The NRF suggested in October that total holiday spending would be up 4.3 to 4.8%. And later, data from Deloitte suggested that spending increases this year would hit 5%. But it turns out, Leighton, that the best case scenario might have happened for retailers and the economy as a whole.
Yeah, it certainly has been a really good couple months for retail and the retail environment. And I think a lot of that has to do with consumer sentiment is still up. The overall market economy is doing very well despite all of what you've been seeing over the last few weeks in the stock market. A lot of skepticism there in the stock market, but you're talking about equities markets where there's a lot of speculation, a lot of people saying that it's going to go up or down. The relief from the tax cuts is going to go away in 2019. All of these things, all of this rhetoric really hasn't affected what the average consumer does when they go into some of the retailers we're going to be talking about a little bit later. A lot of those retailers performing extremely well. And even some of the retailers we're going to talk about that are underperforming relative to the market still are doing pretty well. And the fact that a lot of retailers haven't had to file bankruptcy that we thought were in trouble in 2017. So I think overall, the big picture, and I think what this Mastercard study tells us is that everything is going just fine. And I think 2019 is actually going to be a banner year for retail, even though some of the comps may come in a little bit softer because of the nice quarters we've seen here during these earnings reports. But according to Mastercard, the holiday spend this year hit over $850 billion. That's B as in billion, a figure that many of our listeners have actually already heard because a lot of the news outlets cling on to that very large number. But within that figure, we see shopping sales in total, so absolute sales growth, hit 5.1% year over year, far more than inflation, as a lot of people have noted, is hovering right around 1.9%, still not meeting the Fed's target of 2%, and more than GDP growth, by the way, in the fourth quarter that may come in between 3 and 4%. That number has actually varied quite widely. If you look between the first calendar quarter of this year and right now, a lot of people are saying that GDP is all over the map. They just don't know how to really calibrate that. But as it pertains to retail, those sales are going to be higher than GDP pretty much any way you look at it, especially for the last 2 months, which is exactly what this Mastercard study tells us. Is sales between November 1st and between Christmas Eve is really the retail sales that we're looking at here as far as that 5.1% increase. And even though that absolute number of consumer dollars coming in sounds like a lot, that $850 billion, it's actually the highest percent increase in spending over the last 6 years. So again, we're talking about a strong retail economy. That tells you right there. The last 2-3 years in retail has been a banner time. But just to say that that increase over the last 2 months is at a 6-year high really says something about how things are moving along. Now, the definition, again, is between November 1st and Christmas Eve. So you have to keep that in mind with these historical measures, because oftentimes these months are going to be the strongest months relative to the previous months in a given year. But during this time, there have been massive marketing campaigns by virtually any means. And that's been extremely important because you think about the last 2 months being a banner year as far as traffic. Well, how does that traffic occur? You really have to look at the root cause of that. And that causation, Trent, is social media. Everybody is on social media. They're seeing the hot trending items, either it's apparel or toys, or even, as we'll mention here in a little bit, home improvement items. So a number of retailers have been spending really top levels in terms of their ad campaigns to get their messaging out there, to get their product assortment out there, because it's not just about the sales figures. It's not just about the promotions, a certain percent off of a certain type of item. It's those certain type of items that's really driving that traffic, because they really know all of that new data coming in. They know what's hot. They know what's trending. Even if something has just come out just in the last few weeks and the sales are up, they're going to promote that item. They can get it to market in terms of the ad campaigns much, much quicker now. We're seeing about 75% of the retailers we've covered this year on the podcast beating on the top line as a result of some of these marketing campaigns. And it's interesting because even for more of the bearish analysts out there that were predicting that retail sales figures would be much softer, maybe let's say in the low to mid 4% range that the NRF had listed, they would really have to be anticipating a dramatic drop off in the current traffic trends because, again, like I was saying, between quarters 1 and 3 this year, this calendar year, they've all been very, very good. So to see a dramatic drop off in that trend would mean that something maybe geopolitical would have happened. We did not see any of that. And that is to the benefit of a lot of these retailers. And many retail executives, by the way, said that traffic and sales per transaction were bolstered simply by giving their customers what they wanted when they wanted those items. And I think that's extremely important because if you think back to the comments that we've covered during Target's earnings call, they say just that. It's product assortment 1, convenience number 2, and they don't have to be one in front of the other, but they do both have to occur for that retailer to succeed. At least that's how they see it. And timing and convenience were certainly a key, but you look at the toy ads, even recent toy ads from Walmart and Target suggested that they know exactly what brands and toys were on brand for kids this holiday season, and they drove that messaging home immediately. And I think, to my previous point, that is exactly what's helped the traffic levels and the spend per transaction at some of these enormous retailers this holiday season.
When we mentioned toys, but there were a few areas in retail that got the rub this holiday season that we were wondering about going in. Apparel sales being one of them. That's an area that commonly sees areas of softness with some niche retailers that quickly fall out of favor with the American consumer, which is actually something we kind of saw in 2016 and to a limited extent in 2017. Apparel sales actually grew 9%. Now, retailers like Ross, TJ Maxx, Burlington didn't have a lot of sales due to their off-price nature, but they certainly benefited from more people being out and about while visiting competitors. And while we mean didn't have a lot of sales, we're talking about just in terms of that overall top line versus some of their other competitors. Home improvement sales grew 8%. We'll talk about a home improvement retailer a little bit later on in the show that saw massive same-store sales increases during all of 2018. And perhaps all of the people using vacation time over the course of the holidays were able to make some changes in their homes before going back to work in 2019. So all of this sales talk brings us to a question that we've addressed over the last 3 years, which is, how were sales dollars dispersed within the brick and mortar and e-commerce landscapes in terms of that divide? Well, transactions and transaction amounts were up online as could be expected, sales being up 19.1% in the stated time frame. During Black Friday alone, Adobe Analytics saw sales increase online by 23.6%, so there's been a little bit of leveling off since then, which of course we understand as you get closer to Christmas, a lot more of those shipping guarantees kind of shed away. Amazon had 81% of online traffic for their internet sales from December 1st to December 19th, according to Edison Trends, which is a firm that tracks the market share of online retailers. Now, brick and mortar sales remained neutral, although there's not so much data out there in that regard. Now, regarding brick and mortar sales, we do see that a majority of the increase in total sales, where there was an increase, came from more people going to different retailers' websites. Now, brick and mortar roughly still took 87 to 8% of the retail sales pie, still an enormous amount, and that's versus online stores. So brick and mortar stores still doing fairly well. We'll see as far as when the earnings calls come out, how that breaks down for the brick and mortar stores that are edging into e-commerce, whether they're seeing sales increases as a result of in-store traffic, as a result of online traffic, or a mixture of both. Now, despite all of this very good news, certainly for us on the podcast and for the industry as a whole, legacy department stores, again, this is according to Mastercard's Spending Pulse survey, saw sales fall 1.3%. And we tend to think the closure of hundreds more Sears stores played a role in this, since after all, if you don't have the stores to shop at, those sales are obviously going to fall. So even though Sears wasn't bringing in a ton in terms of sales, that still would impact the bottom line. Same thing with JCPenney. People tend to forget that JCPenney closed a number of stores at the beginning of the year as well, and their sales generally have been falling low single digits in the face of Macy's and Dillard's, both of whom have done much better in 2018 than many would have thought. Dillard's seeing low single-digit increases in same-store sales, Macy's seeing likewise. JCPenney this last week actually saw their stock go below the $1 mark for the first time ever, at one point just above a $300 million market cap. Some of that, though, of course, due to the larger market sell-off that we saw within the last couple of months. So now to our list of lowest performing retailers and highest performing retailers of 2018. Again, this is just more or less based on our opinion. We'll bring some facts certainly into the fray to kind of back us up on this. But if we left someone out, or if you think we could have made a better selection somewhere, reach out to us on social media. Again, Twitter and Instagram at Retail Podcast. And first, we're going to look at the lowest performers. This is a brief reminder that this doesn't include any companies who declared bankruptcy in 2018. Again, Sears not being included in this list, Toys R Us not being included in this list. So we always talk about who we considered for this list, and honestly, it was a tough year to find inclusions on this list. Most struggling retailers either declared bankruptcy like Sears or Toys R Us, or showed some signs of a turnaround. Now, JCPenney was probably the top retailer that we left out. Although their same-store sales aren't tanking, they're still searching for profitability, but we wonder if the loss of Marvin Ellison may not be a good thing for them long-term. As Leighton and I have talked about, we're kind of questioning his legacy at JCPenney, questioning some of his early moves at Lowe's. So we'll see if maybe JCPenney can turn it around long term. We'll at least give him another year before putting them on this list. Speaking of Ellison, by the way, we also considered Lowe's, but again, we'll wait until next year on them. Their same-store sales are still growing. They're just hemorrhaging market share away to Home Depot at the moment. Rite Aid was a close call, but we had to save space for actually another retail pharmacy chain we'll get to. And we also thought long and hard about squeezing Bed Bath & Beyond on this list, but again, they narrowly missed, as did Lumber Liquidators. So Leighton, will have you start at number 5 with Office Depot and Office Max.
Yeah, so this combined company really has not done too well, because you see a lot of market consolidation, right? And the office supply network, there's really only a couple brick and mortar retailers left. Office Depot, which has Office Max, and then you have Staples. And those are really the two main ones. Is for the business side of things, Amazon really has taken a fair amount of market share away. But here we're going to be talking about the retail segment only for Office Depot. So we're not going to be delving in to their business services side of things, which has actually done fairly well as of late. This is where we really have to make the differentiation between their overall business, which is doing okay in terms of revenue growth this latest quarter, versus the retail segment, where Office Depot and Office Max, they really have been struggling as of late. The struggles have been going on for some time and ultimately led to an initial merger between Office Depot and Office Max, and another failed merger between those two and Staples, as everyone would remember from us talking about this on the podcast when it was occurring. Merger ended up getting shot down for a number of reasons, but it left us really scratching our heads, because overall Office Depot still hasn't proven out a robust strategy going forward. And this is why they're number 5 on our list in terms of the least performing retailers of 2018. While Staples has acquitted themselves decently, it seems, after going private and closing a number of their stores, their underperforming stores, Office Depot and Office Max continue to struggle on the retail front. Their service-based businesses are faring well with their CompuCom acquisition, which may bolster in the coming years. That said, the retail businesses have been struggling in the face of generally stronger retail sales in the U.S. Shortcomings at Office Depot are more of a product of their business model than anything. From time to time, we talk about the idea of beta, or companies that fluctuate up or down with the larger market economy or economy in general in terms of what's going on in the macro scene. In this case, Office Depot, they really operate independent of other retailers because their business hinges on business-to-business transactions and dynamics. Even from a distance, we can see that businesses with this model may struggle as there is an increased corporate emphasis on reducing paper use, meaning a major slice of their business is in the process of being eroded. And you see that with huge corporations in all sorts of facets, such as manufacturing, really going paperless just in the last couple of years. Just when you think that everybody's going online and transacting there are still a lot of businesses with a lot more ground to cover in terms of being green or efficient around the corporate setting. And they found some strength in office furniture at least, but outside of that, very little from a retail perspective has been encouraging for Office Depot. And to that end, their comp sales have fallen in each of the last 3 quarters. Product sales in their most recent quarter, the third quarter of 2018, were down 7% year over year. Retail service sales, however, were up 11%. So this really speaks to the idea that the products that they sell day to day, they're just not seeing the demand that they once did. Comp store sales, likewise, also took a hit, down 5% in the third quarter, down 4% year to date in 2018. However, the future may look slightly better for the company as a whole, and that's maybe why they're not number 1 on the list. They're number 5, as they've started to use their massive footprint for their services division. We can envision a future where various business services offered take up a higher percentage of real estate in their stores than actual products. And you see some of their newer stores, or the newer layouts that they've envisioned for their stores, really focus on having a more open feel and offering those services, or at least promoting the services that they have online in their stores. And this shift will allow them to potentially condense square footage long term when possible, saving on lease renegotiations, or maybe exiting spaces for smaller spaces entirely. Their store footprint has also stabilized somewhat, with just 6 net closures in 2018. And Trent, this compares to plenty more over the last 2 years. Dozens have closed all around the United States. Generally, we don't expect them to appear on this list next year as they continue their pivot away from retail into business services. But again, definitely a company to keep an eye on, and a company that we will be really talking about in 2019.
All right, now let's move to number 4 on our list with Stage. Now we're talking only about the full price stores at Stage. So this is minus the Gordman's banner, who we'll discuss later. So we're discussing Goodies, Stage, Beals, Peebles, and others within Stage's larger full price banner. Now the positive results from Gordman's in 2018 couldn't overcome the rough performance by Stage's legacy brands. It's never a good thing when your CEO on an earnings call points to positives by saying non-apparel sales were up 3% when honestly your company's main job is selling apparel. This actually happened in the first quarter's earnings call. One of the weird things, by the way, about Stage's earnings calls, they're pre-recorded, so not a lot of chance for back and forth there. Comps were down company-wide. That includes Gordman's by 2.8% in the first quarter of this year, and it went downhill from there. They were down 5.5% for full-price stores in the latest quarter, which was quarter 3 of 2018. And worse, the company kept forecasts around positive 0% to 2% for same-store sales, thinking that they could turn it around. But in November, they finally gave in, revised that number downward now to negative 0.5 to negative 1.5% for their entire brand holding. Now, the bottom line for Stage doesn't look much better, as they expect a loss of $1.90 to $2.10 per diluted share for this calendar year. However, despite a rough showing from this brand, we do want to remain slightly optimistic towards their future. They're pouring more resources into home goods in their full-price department stores, meaning they'll be quietly taking floor space away from the underperforming clothing segment. As a company, they're beginning to reorganize as well around the off-price concept, meaning we could see some flex space in their full-price stores in the future. But one thing that we noted throughout 2017 was this effect where stores that are in mid-sized markets or smaller markets, like you see a lot of Stage stores, you see a lot of Goodies stores there. In the smaller markets, they were suffering. Maurice's was also suffering at that point in time. Same deal. They have a lot of holdings in smaller markets. Hibbett Sports also suffering. Well, Maurice's, or at least Ascena, has begun to turn it around. Hibbett's begun to turn it around, but Stage is still kind of lacking in this aspect. So we'll see if their strategy to replace some of their regular stores, their Stages, their Goodies that are underperforming in markets that are smaller will benefit them going forward as they're starting to replace those stores with Gordman stores in those smaller markets, oftentimes becoming the first off-price store in a particular market. So time will tell about that strategy, but the bottom line is very clear in that Stage and the full-price brands under Stage not holding their weight at all within the company. Same-store sales are really struggling, even as similar brands like Ascena Retail begin to see a little bit of a turnaround in their own same-store sales.
We move on with number 3 with Shopko, a retailer that we actually recently talked about. However, one that we don't typically talk about on the podcast because, as we'll mention, they are a privately held institution. But we talked about Shopko closing 39 stores in 19 states a few weeks ago. And we firmly believe that this is only the tip of the iceberg for Shopko. And we didn't outright say that during that story. We did allude to further pressures in 2019 for Shopko, but they are a private company, so we don't get much regular looks into their financials. So it pretty much is all speculation from our side of things. But we've heard from sources close to the company that most of their stores just aren't performing well, especially those smaller hometown stores in regional areas that really aren't seeing the type of traffic that they would want, especially those markets where you're seeing maybe a new Dollar General, new Family Dollar opening up. And they really aren't considering new markets at this point. To that point, they just announced this week the closure of one of their full-line stores in Orem, Utah, one of their faster-growing areas of the country. Additionally, they've negotiated minimum sales requirements in some of their existing leases, and we know of a few markets who are likely to lose their Shopko stores when these minimum sales requirements aren't met over the next 2 years, because it may just be $1 to $2 million sales requirements per store, but they still aren't able to hit those marks. So while the landlord or whoever owns the store is pretty confident that they'll hit those marks, or did at least when they signed the lease, it's not happening. In fact, we were surprised to see that some of the markets we've heard will be losing stores weren't on the most recent closing list. So there's potentially a lot more to come for Shopko in terms of store closures. And the store closures, along with the letters to suppliers attempting to squeeze prices down in order to better compete, or at least get money more drawn down to the bottom line, leads us to believe that the chain is underperforming as a whole. I know, Trent, that you had talked to me about a recent trip to a Shopko hometown that revealed a half-full cooler section with broken coolers and long segments of empty shelves in the store. Not a good look for Shopko. Might this suggest they are hesitant to fully stock shelves because of the financial issues? Again, we're talking about suppliers really not being too flexible in pricing and them really trying to shore up short-term leverage and liquidity. It is a concern about the square footage potentially of the stores. Maybe it's too much. Maybe it's too much square footage for them to handle. We think of Alco Duckwall years ago, before their bankruptcy, opening up newer stores or trying to sustain current stores that were simply too big. Think about the footprint of an 8,000 to 10,000 square foot Dollar General. It's a little bit less than some of these hometown concepts. Or is it simply just mismanagement on the store level? Either way, we would not be surprised to see Shopko head towards the bankruptcy lands in the next year or two. This is a retailer that we've rooted for in the past. We love their full line concept. We love the hometown concept because we know the residents love the hometown concept. They love being able to have a better apparel selection than maybe a Dollar General or a Family Dollar. They have frozen goods. They have a ton of stuff that you would need regardless of what type of city you live in and what your population is. However, they have just not been able to squeeze out the right margins. Operating some of these build-to-suit locations have been far more expensive than they originally anticipated, really leaving us with no choice but to leave them at number 3 on this list for 2018's least performing retailers.
Number 2 now is another retailer we talked about recently on the podcast is Gymboree. Gymboree hasn't technically declared bankruptcy again, but it sure looks as though they're headed in that direction as 2018 draws to a close. This after applying for bankruptcy in 2017 and closing a good chunk of their store base, around 340 locations when they did that. Now, back in October 2017, they exited their first bankruptcy filing. Following bankruptcy number 1, they emerged with a $200 million credit facility and an $85 million term loan replacement facility. This apparently was not enough for the company. It was noted by the Wall Street Journal earlier this month that they are now seeking a bankruptcy loan while it attempts to find a buyer. In November, Gymboree said that they were seeking strategic alternatives, which is usually code for attempting to sell one or more brands to keep the ship afloat. And much like Toys R Us, much of Gymboree's debt came from a leverage buyout back in 2010. However, the business hasn't been profitable enough to make finances work. Now, because they're a private company, we don't have specific sales, but indicators from people close to the situation are that same-store sales have not experienced a turnaround from their new Gymboree ad campaign, something that they've rolled out a lot of in terms of internet media, that type of thing, digital media, and strategic redesign for the company. That hasn't really panned out as well to bring people into the stores. However, other similar brands, such as Carter's, also have mostly spun their wheels during 2018. Even though Carter's saw slightly increased same-store sales across their brands, they did note on their earnings calls this year the loss of wholesale sales from both their private label brands as a result of Toys R Us closures, as well as soft demand for the products overall. This is something that we've talked about quite a bit as we start to see birth rates get lower and lower and lower. Ultimately, there aren't going to be people to buy these products, which are generally geared towards kids in this case, for Gymboree, whether it be Toys R Us, whether it be Carter's. Now, we saw toys be a robust category this holiday season, likely because of discretionary income, but when it comes to kids' clothes, if kids aren't being born at the same rate they were, you kind of wonder where the runway is for growth in the future. Now, a lot of the thought is that if Gymboree does have to file for Chapter 11 bankruptcy again, it will go on through with liquidation, and we may see them no longer in 2019.
We move on to a retailer that just had to make the list, and we alluded to it earlier when we talked about Rite Aid. We're going to delve in to the retail pharmacy segment with number one. No, it's not really an award for them, but Fred's Pharmacy came at number one for us in terms of the least performing retailer. The last time we talked about Fred's Pharmacy, which operates in the southeastern part of the United States, was back in September when they announced positive news with Walgreens, where they would be buying a huge chunk of the remaining pharmacies. And we're not talking about buying the entire stores. We're talking about just the pharmacy divisions. At the time, the news to us came about with around 185 pharmacies going to be in line for Walgreens to take over in the first quarter of 2019. These 185 pharmacies were going to be in 10 states. They were going to be bringing in $165 million plus, paying for all the inventory and supplies per each pharmacy. This number was originally 185, like I said. It's now dwindled down to 179 after Walgreens has done their fair amount of due diligence during this process. Of course, we knew that this number may be reduced a little bit, and that it was. So just 6 stores down from the original 185. Regardless, we transition back to why they're number one here on this list. The transaction is still slated to close in the first quarter of 2019, but this was not enough to really keep the company off the hook in terms of bad news for the rest of 2018. Many of the stores not listed in the Walgreens agreement are slated to now close. We're talking about the pharmacy sections of the store. So when I say stores, I mean just the pharmacy areas of the stores. Fred's right now operates 600 convenience stores or discount stores, many of which, about 3/4 of which, operate a pharmacy, but the majority of those now are not actually operated by Fred's. Fred's cannot do well operationally, therefore has sold to a number of regional operators, and now, of course, Walgreens taking over 179 pharmacies in the first quarter of 2019. But Fred's will continue to operate the retail storefronts of these 100 locations. This news came out about 2 weeks ago, really left us shaking our heads, Trent, because this really makes you think they really only have one strategy, and that is to now pay attention to the retail part of their business. But that has been not as bad as the retail pharmacy part of their business, but it hasn't been great either in terms of the overall sales increases, the same-store sales increases that we typically see from CVS and Walgreens. While they're lagging too in terms of the actual retail type of business they do with toys and consumables, they still don't perform that well in respect to their competition. They will be closing these 100 pharmacies, by the way, in Tennessee, Mississippi, Arkansas, among others, with retail pharmacy sales increasing steadily over the past decade or more, and more to come, by the way. We have to question what it is about Fred's where they're unable to operate sustainably within the pharmacy sector. cash infusion from Walgreens would help to pay down debt, sure, but they still have not proven out that they can effectively run a retail pharmacy, much less a corner convenience store, as I had just talked about. Looking through the areas in which Fred's still does business, new convenience stores and, by the way, new regional pharmacies have been opening up on or near the same block, the same corner for locations for Fred's that have been operating for decades now. In their latest earnings release, which is, by the way, for their third quarter ended November 3rd, Fred's showed again why they were just not performing this year, and their net sales were down 5.5% to $306 million versus $324 million in the third quarter of 2017. Comparable store sales decreased about the same amount, 5.3%. So this really tells you that it's not just shutting down a store here or there, maybe one store per quarter. It's declining comparable store sales aside from their pharmacy business. So they have not been able to operate effectively in nearly any facet of their business. A net loss, by the way, from continuing operations ticked in very close to $31 million. This time last year, it was around $50 million. So it went down because of some cost-cutting initiatives, which were really the only positives we could derive from this latest report when we were doing this research. Their strategy of cost savings has really brought margin improvement, and they are reducing the cost in terms of selling, general, and administrative expenses. However, cost-cutting has proven more to be like the Sears strategy, where consolidation in some areas, some of the areas they operate, has not equated to much needed investment in other areas. Because think about 7, 8, 9 years ago with Sears. They were saying that cost-cutting is going to be the equivalent of sustaining their business model for years to come because they can consolidate, they can save money, whereas their other competitors like Walmart and Target just keep reinvesting. Well, that is exactly how you sustain a retail company, especially in this century. So while the balance sheet for Fred's Pharmacy may be a little bit stronger in the short term, we expect more of the same for Fred's and their nearly 600 discount value stores in 2019 because of this losing strategy. It would be one thing if they came out and made a clear strategic outline of what they're going to do with the $165 million cash infusion from Walgreens in the first quarter, or all of the other cost savings. Where is that going to be funneled to? Yet we have not gotten any clear outline from executives. Their stock, by the way, has hit all-time lows this year in 2018 of $1.30 per share. They've actually been listed on the stock market since May of 1992, once with highs of around $38 a share in 2003, now just a $70 million market cap for Fred's. And again, a story we will definitely keep an eye on, but one that we are not optimistic about in 2019.
So Fred's caps off the list of least performing retailers in 2019. Now to the highest performers. This is a crowded list to choose from this year. A lot of businesses put forth strong same-store sales, so we had to consider just about everyone, to be honest, in this age of robust same-store sales and comp sales, despite some margin compression for certain retailers. And although there are no exclusive grocers on this list, we included Aldi and Trader Joe's in our conversation. We also considered including Tractor Supply Company, who showed remarkable consistency in what can be a sometimes volatile segment because of weather and other factors. Five Below, we also considered. They also had an exceptional year with selling, as one analyst put it, things that nobody actually needs. But we start off our list with an honorable mention. Not strong enough simply because of past performance, improvement over past performance, if you will. Not strong enough to get them onto this list. But we wanted to give them a shout out anyway in Gordman's. You know, for Gordman's, what a turnaround story this has been post-bankruptcy. I think it's one of those brands that a lot of people saw when it went into bankruptcy that it could potentially be successful. Gordman's was taken in by a retailer on our most struggling list, actually, after bankruptcy, in Stage. And Stage, that seemed like a recipe for disaster. Stage wasn't performing well. Gordman's wasn't performing well. How was there going to be a positive out of all of this? But instead, all Gordman's has done is actually been growing organically through same-store sales or comp sales and through adding on new locations. And one could argue that Gordman's is now single-handedly holding Stage afloat with these excellent comp store sales returns and good early returns in new markets that they're entering. We mentioned on a prior broadcast how Stage is now spotting underperforming stores and one of their other banners and replacing them slowly with Gordman's, as was the case in Hays, Kansas, for example. Overall, Stage is in the midst of converting 5 to 10 stores to Gordman's, allowing them to save on potentially expensive broken leases because they were planning on just shuttering these stores before. Now what they're doing is they're being creative about it, replacing that store with a Gordman's, and the Gordman stores are performing. So this is saving on the broken leases, but it's also making sure that their store portfolio stays about where it used to be in terms of numbers. In their most recent quarter, comps for Gordman's rose nearly 10% at 9.9%. When you account for a calendar shift, it was actually over 10% in the most recent quarter, and this was after an 11.4% increase in the company's second quarter of 2018. Now, the true test will come long term because, again, these comp increases are on top of sales that weren't necessarily great to begin with for Gordman's because, again, there's a reason they were in bankruptcy. So, like I said, true test will come long term. If Gordman's can stand out, find a way to poke their head above consistently improving performance from TJ Maxx, Ross, and Burlington, they may be in good shape going forward, and Stage certainly thinks so, as the number of Gordman's stores has grown from just over 40 after the Gordman's acquisition to around 70 stores now. So we're seeing Stage invest in this banner. The banner is providing Stage with additional financial support now, additional comp sales metric increases there. And so we'll see if Gordman's can really differentiate by setting themselves in these small to mid-sized markets above the likes of Ross, TJ Maxx, who don't often move into a market below 50,000 overall people. So that's an honorable mention on our list. Again, if only because the previous years were so bad that it certainly is going to take them a couple of years to prove themselves out, but just wanted to give Gordman's a shout for really performing in a positive manner so far in 2018.
What a tremendous turnaround story there. And if you're a listener that currently does not follow us on Instagram, we do have a couple pictures on there depicting their excellent customer service in 2018. We move on with our number 5 retailer. This is going to be a tie. So I said retailer, it's really retailers, because basically both retailers on this list, we're going to be talking about Target and Walmart, are large, mature retailers that displayed genuine organic growth through brick and mortar and e-commerce sales in 2018. And we talk about mature retailers being unlikely to see massive jumps one way or the other in terms of same-store sales. Both retailers saw same-store sales increases spike over 3% at different times during this year. By the way, the third quarter for both retailers came in just recently. By the way, we talked about them both on the podcast just weeks ago. Target having an over 5% increase, including digital sales. Walmart's U.S. brick and mortar sales, again, U.S. brick and mortar sales coming in at a very robust 3.4%, which even blew executives away. They were thinking above 2.5% would be what they would see. But rumors of an even stronger fourth quarter have done well for analysts and executives at Walmart and Target over the past couple of weeks. And each retailer has really begun to shore up certain weaknesses in 2018. We talk about older, stagnant retailers that are mature, very large retailers such as Target and Walmart, really not adjusting to the times. But for Target, it was their ever-struggling grocery section where they trimmed back on inventory and shrink in 2018, ever improving in that particular area of their stores. For Walmart, it was continued investment in buy online, pick up in store, which used to be a train wreck. Trent and I have both had horrible experiences at Walmart picking up items that we had once bought online. They were one of the first retailers to roll that out, but it was always a disaster. Now they've removed a vast amount of friction from that process, so it's at least a little bit better for the majority of those customers trying that out for the first time. Sure, both retailers had a bit of an issue with margin compression in 2018. I just spoke about Target and their ever-struggling grocery section. Margins there are always going to be tight, and this is something we're going to talk about in another retailer. I won't give it away just yet, but another retailer on this list. However, we believe the price investments were smart to make and position both retailers favorably against competition now and going forward. Target now is basically in a class of their own as far as a designer general merchandise retailer who can compete on price as well. So you go into any Target, it's going to be clean and shiny and really sections of beautiful displays everywhere, but they're still able to compete on price, and that is extremely important even for those people who aren't as price conscious as your average Walmart consumer. And as for Walmart, and their neighborhood markets, they are now well positioned to compete against both value grocers and smaller general merchandise retailers like Dollar General and Family Dollar, who we've mentioned, neither of which can offer buy online, pick up in store to the extent of Walmart, at least for now. So including both retailers here is as much about what they did in 2018 as how they position themselves for 2019. Remember, both took a beating in 2016 and 2017, especially on the stock market, as other media outlets trumpeted a retail apocalypse. Neither brand panicked. Both stayed the course. Both stayed on strategy. Both, by the way, didn't have huge executive hiccups. Both still have the same CEOs, and both are now reaping the benefits from it as they head into 2019. Target stock, by the way, hit around $50 per share in 2017 before peaking around $85 per share this year before the larger market sell-off in the fourth quarter, now around $65 per share for those of you keeping track.
So we move on to number 4 on our list in Costco. Costco, much like Target and Walmart, noted margin pressures in their last earnings call of 2018. Now, this earnings call likely kept them out of a higher spot on our list, but we feel as though they still generally killed it in 2018. The main notables for Costco, despite that margin pressure, have to do with comp sales increases and growth in market share. They benefited from various Sam's Club closures in 2017 and 2018, and also managed to stake claim to solid numbers of membership increases during the calendar year. Anytime there's membership increases there, you know they're nibbling away at overall market share. Still, when we look at domestic comp sales numbers throughout 2018, we cannot help but be impressed for what is a mature, well-established retailer. Adjusted for calendar movements, their first quarter of 2019, which came out just a couple of weeks ago, showed same-store sales increases of 8.3% in the U.S., 26.2% for e-commerce alone. For their fiscal year 2018, they reported same-store sales increases for the entire year of 9.4% in the U.S. Again, those numbers absolutely incredible for an established U.S. retailer. Costco can kind of be credited in this sense for bringing people back around to the membership warehouse concept as economic conditions continue to improve in the U.S. Sam's Club saw moderate gains in terms of same-store sales, but nothing to the extent that Costco saw. As with Target and Walmart, Costco shored up perhaps their biggest issue in 2018 in e-commerce. Their e-commerce investments compressed margins somewhat, but again, a necessary expense, at least that's how we saw it, as company efforts to catch up were absolutely crucial in 2018. It was kind of a make or break year in terms of e-commerce for Costco because they didn't do it in 2017 and 2018. It's likely that they were going to be left behind altogether. E-commerce sales increases of around 30% for the calendar year is now in line with retailers like Walmart and Target. We can easily see a future where Costco sees increases of 40 to 50% in terms of e-commerce sales soon, perhaps as soon as 2019. Now, the main question with Costco going forward is where they can squeeze margins out now, because their margins have started to be compressed. Still better margins than a lot of different retailers, but some analysts are a bit wary going forward. We believe they may be better served to hold off on offering that special dividend that Costco is so well known for among their shareholders for a bit. A lot of Costco employees with stock, though, have kind of come to expect it. So we'll see what Costco prioritizes going forward, whether they prioritize kind of keeping their employees happy and on board with the overall direction of the company, or whether they look towards trying to keep analysts and potentially shareholders in the long term happy, as some shareholders, while they would be happy to see that special dividend, would likely rather that dividend go towards internal growth, go towards other pricing investments. That margin compression, by the way, has hurt the stock price in the last few months, but Costco did hit massive all-time highs in valuation this year, highs over $245 a share in September. Back before kind of a bookkeeping hiccup that was released at that point in time, they peaked again for a brief amount of time in early December, back above $220. Currently, shares are at $202 after starting the year at $188 per share.
We move on from big box retail to niche retail with Bath & Body Works. Considering the relative struggles of sister brand Victoria's Secret, it may be a surprise to some to see this retailer on the list, but here we are nonetheless. This has much to do, or as much to do with their success, which they've had plenty of, as it does about the headwinds facing them. First, L Brands, the parent company, has basically been using Bath & Body to prop up Victoria's Secret up until recently. Second of all we hear about is the failure of malls. Malls are dying. Malls, C-class malls, B-class malls, they're all dead. How they've become so unpopular, how traffic is down, how no one likes to shop at them any longer. Yet Bath & Body Works still has a significant amount of their store space tied up in these conventional malls of all classes, by the way. I've seen them in several C-class malls still to this day. They're in a great position, and they've been steadily increasing sales and traffic across the board, even in some of those underperforming malls. Known for their frequent flyers and loyalty promotions, they have not tapered with the strategy of sale inundation in 2018. A lot of people were saying that Victoria's Secret, one of the things that they did that was unpopular was to take out those flyers or to mail people a lot less that were on their mailing list. Bath & Body Works, for the most part, still has the same strategy employed at their operations center. So particularly during the last 2 months, or the biggest months of the holiday shopping season, Bath & Body Works has been a great driver of traffic because they're offering promotions such as 75% off or $5 off flyers or free products if you come in and there's no obligation to buy anything else. This same strategy that they've had for some time now has proven effective when bringing in new customers as well. Customers that, by the way, have been buying more, a little bit more each time they shop. And that's really been proven out in this latest November sales call where they invited pretty much everybody to listen in. And they invited everybody to listen in from their website, their investor relations website, Did L Brands, because comps were up 18% for Bath & Body Works by what the company called a strong product acceptance from their customer base. And so sales for the month exceeded management's expectations, driven by record volumes on key shopping days. We think about Black Friday having been included on this metric. But in addition, all of the new rollouts for December, seasonal fragrances and low price point gift ideas, holiday gift ideas, seem to be taking hold. And what's interesting, Trent, is if you go back 3 weeks ago when they talked about the very strong November sales call, well, one of the things they talked about was the initiatives they were going to have in the next 2 to 3 weeks. Those initiatives have worked extremely well for them. During their latest quarter, by the way, Bath & Body Works same-store sales hit 10%, coming up against tough comparable quarters, around 4 to 5%, and making the company as a whole positive in the face of Victoria's Secret comps remaining just slightly negative. As we've alluded to in this particular story, Victoria's Secret has been doing a little bit better, but for their latest quarter, negative 2% same-store sales for Victoria's Secret. Combined with e-commerce initiatives, by the way, sales were up 13% year over year for Bath & Body Works. We expect more of the same for this retailer in 2019. And as they look to really adhere to an identical winning strategy of product assortment, promotion, and online integration. That online integration has been slow, but guess what? It's been steady for them, and it's been consistent messaging across all platforms. And that, in my opinion, is key to keep your current consumer extremely happy with what you have to sell.
On to number 2 on our list with Ulta Beauty. Now, Ulta has been so good for so long, it's easy to overlook their success, and certainly we're a bit guilty of that ourselves. We actually wondered aloud when going through this very list last year on the podcast how on earth they could keep up both same-store sales increases and such large unit expansion, as we were becoming accustomed to seeing double-digit same-store sales increases and becoming accustomed to see double-digit unit expansion. Well, here we are 1 year later, and they've continued to do both things, even comp sales up against extraordinary comps from a year and 2 years ago. In their most recent quarter, they saw comp increases of 7.8%. It's driven by increases in both traffic and average ticket. And we throw around the terms firing on all cylinders a lot, but here is a retailer literally hitting on everything. The one thing we might dock them on was SG&A going up, selling, general, and administrative expenses going up as a percentage of sales, but this is a direct result of increasing sales on a per-store basis because Ulta's sales model is predicated largely on a personal approach. So store staffing, absolutely critical for them to achieve the same level of service going forward as more people begin to pour into the store. And as more people have poured into the store, they've had to hire more people, which then has caused SG&A to go up. That will happen when you do go on hiring sprees. So right now they feel like they're at the bottom level of this particular hiring set. So they feel like how many people they've hired can actually support a little bit more in terms of sales, and that'll bring that SG&A percentage back down to what we've been accustomed to seeing from Ulta. Now, back to the new openings part, they actually opened 42 new stores alone in the third quarter of 2018. That's very close to the 48 they opened in 2017's third quarter. But one thing I wanted to note here is that they've been decreasing their pre-opening expenses on a per-store basis. This is crucial for a retailer like Ulta, like Five Below, who we mentioned earlier, that's opening a lot of stores nationwide. They still feel like there's a lot of white space for them nationwide. They're becoming more efficient at opening those new stores. Their per-store pre-opening expenses from last year were $9.7 million. This year, $7.6 million. So they're not only continuing to open all of these new stores, but they're becoming much more efficient at doing so. That's a massive decrease on a percentage basis, and that's helped their bottom line. Their increases in same-store sales and the new openings all contributed to around 25% growth of net income in 2018, along with the company just being more efficient overall. So this is a retailer that so far over the last 3 years, with all the retail up and downs that we've seen since 2015, they can do no wrong. From marketing to real estate to sourcing to inventory control, makes them our runners-up for the best retailer of 2018. They've been on our list now all 3 years that we've done this particular list, and it would be no shock to see them on this list next year in 2019. Ulta is just getting it done at so many levels, and even though they're not number one on our list, what they have managed to do, which is stack positive comp after positive comp, and not just slightly positive comp, we're looking at upper single to lower double-digit comps every single quarter for Ulta. They just continue to build that loyalty in store. They continue to build on such a great marketing presence on social media. And honestly, Ulta, one of our favorite retailers in general. No surprise that they show up at number 2 on this list.
Well, with that, we move into the home improvement sector for the number 1 retailer on our list. That retailer's Home Depot. Home Depot combined a rare triumvirate of solid results in 2018, thus the reason for our number 1 listing here. Despite not having same-store sales improvements as robust as a few of the other retailers we've just mentioned, they did improve by leaps in terms of same-store sales for a mature retailer, which helped their cause. In addition to solid same-store sales figures, the company killed it on the bottom line. And for their most recent quarter, they saw earnings per diluted share increase a whopping 36.4% over last year. So they're growing the top line, but guess what? They're growing profitability as well. Finally, they've been slowly siphoning away market share from Lowe's to such a point now that they really are the undisputed leader in the category of home improvement, while Ace, True Value, Menards, among others, have been able to maintain course themselves. No one has really capitalized on the recent economic conditions like Home Depot. And we talk about those economic conditions being an extremely important point because a lot more people are retiring, a lot more people are doing things like home improvement activities because they have more discretionary income. So this is a sort of perfect storm for Home Depot and the others in the home improvement category. However, it's the marketing efforts, it's the breadth of their business that has really taken market share away from everybody else in terms of capturing that new growth activity. As far as the same-store sales are concerned in the U.S., their comp sales growth was 5.4% in the third quarter, and they expect enterprise same-store sales growth of 5.5% for fiscal 2018. So we're talking about the entire year. So we should know that their international same-store sales have lagged behind their domestic same-store sales, though not to the same extent as Lowe's. So they're still performing better internationally, as Lowe's has actually looked to divest some of their larger international previous acquisitions. This was after U.S. comp growth of 8.1% in the second quarter and 3.9% in the first quarter, all well above inflation numbers. And although we could add some cautionary notes about home ownership rates increasing only slightly in the past year and a lot more people really waiting to apply for new loans as interest rates have been going up in 2018, it's worth noting that these homeowners, about 64.4% of the population in the third quarter, by the way, have more money to spend, which is what I was talking about with discretionary income. And part of this is because of that discretionary income, but also part of this is because homeowners have more equity built up in their homes, about 13% more than a year ago, according to CoreLogic. This opens up possibilities for home equity lines of credit and also for other things that can tie into not only the purchasing activities, but when you think of home equity lines of credit used primarily for, guess what? Home renovations, things that tie in directly to Home Depot's business. And it's apparent that Home Depot is more the beneficiary of this particular category than any other home improvement chain. And unlike with other retail chains, Trent, their gains in omnichannel and e-commerce have not come at the cost of margins. The first 3 retailers on this list have experienced some margin compression due to price competition and e-commerce investments. Think Target, think Walmart. Back in September, Home Depot revealed same-day and next-day delivery for up to 20,000 products in 35 metropolitan areas in the United States. And the promotion is designed as much for pro customers, those contract customers who bring in more per average ticket, which may also serve them well in the battle for contracting space and contracting traffic versus Lowe's. However, do-it-yourself customers may also take advantage of this offering. You think about those wholesale buys. They often deeply discount items that are bought in bulk. And this is happening through services like Deliv for smaller orders, but they are also building out their network for delivery of larger goods. So this is extremely important for both the small common items and the larger goods. They're trying to make it convenient for everybody to buy the products that they sell most frequently at Home Depot. And generally, we find it hard to find a situation where Home Depot is not on this list next year. They may fall back. They may not be number 1, but they're probably going to be on the top 5 list for us next year, as Lowe's seemingly cannot get out of their own way. And by the way, Trent, I talked to a few employees working for Lowe's. Can't disclose any names, of course, but they said that all of the changes don't seem to be that good, but they're also not taking hold. So everything that Marvin Ellison is currently doing in terms of changing the strategy, changing out executive roles, adding executive roles, it really hasn't trickled down to the actual stores, really leaving them in sort of a stagnation period where they don't know what's going to be new. They don't know what's going to be in for their stores in terms of new strategy in 2019, leaving a lot of management scratching their heads. And that's not a good look for Lowe's because guess what? They need the resources. They need the improvement now. They don't need it later. They need it now because Home Depot is firing on all cylinders.
As always, we may have a position in or against companies we discuss on the podcast. Do not invest in stocks solely on the input of the podcast hosts.
We've reached the final segment of the Retail Focus podcast, a segment we call Looking Ahead, where each week we profile a story we're keeping an eye on for the next week, month, or perhaps year, and we start with Leighton.
Well, my looking ahead story has to do with something that Trent alluded to earlier, which is the real estate category. My looking ahead is really a truly looking ahead story for 2019 and beyond, because this has to do with real estate trends in terms of lending in certain commercial property arenas. According to the CoStar Group report that came out earlier this month, a number of anxiety points are hitting big banks. They're worried about the squeeze in rising interest rates and competing non-bank lenders. And what this has to do with, and why I mentioned this story, is because the Fed anticipates raising rates, again, the federal funds rate, 1 to 2 times in 2019, after all of the times they increased in 2018. This type of lending may make it harder for individuals to purchase retail commercial real estate. Therefore, the demand may wane because you can only sell commercial real estate to those people that have private funds available to put money down on a particular asset. And because of that demand falling, retailers may actually benefit because they may actually pay less in terms of monthly lease rate if they were to renegotiate, because they understand, or they should understand, at least the people in the finance or accounting departments of these real estate areas within these retailers, that the actual value of the asset is depreciated. So they may be able to squeeze out a lower lease rate going forward. And this may benefit a lot of the retailers that we talked about in terms of the most struggling retailers. Think the department stores. So JCPenney is one. If they look to either renegotiate a lease instead of turning around and closing a store entirely, it may behoove them to keep that store if they can get a lower monthly lease rate. So I'm curious as to how this dynamic is going to play out, how private lenders have really come to prominence in 2018. You listen to different podcasts where that is the number one way now, syndication everyone talks about. Rather than going to Chase or Bank of America, to get a commercial property loan, you're going through private entities. And I think that's interesting because, again, it may cause demand to shift a little bit and put some more power in the hands of big retail.
So my looking ahead story actually has to do with a business that was on our least performing retailer list back in 2016. That is Neiman Marcus. Neiman Marcus had struggled so much, but they have 5 consecutive quarters of positive comps. However, this is kind of a make or break year for Neiman Marcus. It's a year that Neiman Marcus themselves calls an investment year as they start a new store in Manhattan and start some other initiatives. The reason I'm looking ahead, Neiman Marcus, despite same-store sales increases, still showing a loss. In fact, losses that are even wider on a quarterly basis than they were a year ago. Neiman Marcus also has $4.8 billion in debt that comes due starting October 2020. So in order to try and decrease their interest payments, they've got some reorganization of that debt to do. That's been going on over the last few months, but I'm going to be looking at the entire 2019 for Neiman Marcus. Can the luxury brand retailer, look, they're not going to keep pace with Nordstrom. Nordstrom has outgrown them by this point, but can they at least stay afloat? Can they stay out of a reorganization of their debt that would cripple the company? And can they properly invest in 2019 such that they start to turn a profit in 2020? That's the key. Can they stop losing money? Do those investments in 2019, pay off in 2020. That's what I'm checking out over the next year for Neiman Marcus. Well, that'll do it for us here on the Retail Focus Podcast. For Leighton, I'm Trent. We'll be back with the first Retail Focus Podcast of 2019 1 week from now.
This has been the Retail Focus Podcast. For more, visit our website at retailfocuspodcast.com and subscribe on iTunes or Stitcher. Follow us on Twitter at Retail Podcast.